Senators, thank you for this opportunity. I don't know if I'd say there's never been a better time for you to start looking at tax reform, but I think it's an opportune moment. And I think it's actually overdue if you really get into the sweeping structural issues associated with tax reform. There's macroeconomic factors that also lend themselves to this. And while I don't have an 8-page single-space statement from which I'll read verbatim, I do have a 2 3/4-page statement to which I will refer to make sure I don't miss some points I want to make. I've also given you an article I wrote for the Albany Government Law Review that went into some detail on the history of our personal income tax in particular and on aspects of the tax changes enacted in 2011 for your reference. As you know, Wall Street, which really has been our cash cow for 20 years in terms of marginal revenue growth, is retrenching in an era of slower economic growth in the new economy that we're faced with. Businesses are less willing to shoulder costs they can avoid by moving elsewhere or investing elsewhere. And I don't think I need to point out that most states can offer, in different ways, a lower cost business environment than New York, especially when we're talking about the downstate region where the bulk of our economy is focused. And while we have certain competitive advantages that we offer economically as a state, we can't simply rely on those advantages and ignore the high tax toll we impose on entrepreneurs in particular. Unfortunately, the state's enacted a series of major tax increases since 2009, including what I think it's important to point out is the largest single income tax increase since the 1960s. Only a portion of that supposedly temporary increase was rolled back by the temporary changes you enacted in 2011. And the net effect of the budget you just enacted was to extend a net $5 billion in supposedly temporary tax increases over the next 4 fiscal years, up to $2 billion plus a year on an annual basis. Meanwhile, despite last December's fiscal cliff deal in Washington, tax policy on the federal level is unsettled. I think we all need to recognize that. And when it is settled, it could be settled in a direction that would be unsettling for New York. I can't point out strongly enough that President Obama wants to pretty severely curtail the deductibility of state and local income taxes for high-income payers, and that actually most congressional Republicans are inclined to go along with that idea. Many would like to tightly cap itemized deductions, and there's quite a bit of support for eliminating the deduction for state and local income taxes. That would hit New York harder, and especially our tax base in general, than any other state, any other single state. And in terms of total income, only California would rival us. I think we also should recognize that our last true structural tax reform dates back to 1987, and that since the enactment of the 1995 Tax Relief Act, which was the George Pataki tax cut and our last significant broad-based tax cut, the general drift of state tax policy has been toward targeted tax breaks. The result is a tax code increasingly cluttered with credits, deductions, and other loopholes driven more by short-term policy goals and political considerations than by the basic principles of tax fairness, efficiency, simplicity, visibility, and, last but not least, competitiveness. The epitome of this tendency is the newly enacted program known as Startup NY, also known as Tax-Free NY. The tax breaks offered through this program will be micro-targeted to college campuses and sites near campuses, necessarily entailing, and let me stress, necessarily, under its own terms, it's difficult to do it any other way, a complex multi-step planning and application process ultimately controlled out of the executive chamber. If there's one positive thing that can be said about Startup NY, is that it is so extreme in its targeting, and the tax benefits offered in those micro-targeted areas are so large that it really calls attention to how far we've gone, in fact, gone too far, in our efforts to very narrowly offer tax benefits to some and not to all. I'd respectfully suggest it's time to turn away from targeting and to place a renewed emphasis on developing a tax code designed to encourage all businesses to come to New York or to stay in New York, encouraging them to invest, hire, and grow anywhere in New York that suits their purposes. And as part of this change, to reverse policies that encourage some economically successful New Yorkers to take their capital elsewhere. Now, I have some recommendations in 3 areas. This is by no means meant to be all-inclusive. It's simply touching across the surface of some major themes I'd like to lay out for you, and then we can discuss, starting with the personal income tax. So as I alluded to earlier, in 2009, the legislature and the governor temporarily raised our top rate from 6.85% to 8.97% on rates on incomes then as low as $200,000. And I should point out that in the case of that increase and in your subsequent extension of the increase, the tax increases applied to all taxable income. It was essentially a flat tax on all income, not just a marginal rate. That makes it, for most of the taxpayers affected, a higher tax than you'll find in some states with higher rates, such as New Jersey. In December 2011, a temporary higher rate of 8.82% was extended for 3 more years on income starting at $1 million for individuals and $2 million for couples. But it's continued to apply as a flat tax on all taxable income. As part of the current budget, this increase, which is a not insignificant 29% tax increase, which is nearly $40,000 for couples affected by it, was pushed out to 2017. The temporary changes of the past several years were added to a PIT code that's become more complex and opaque since the enactment of the Tax Relief Act of 1995. For example, our tax form is now 4 pages long. It's twice as long as the federal 1040 form. And that doesn't include the extra paperwork necessary to claim all of the income tax credits that you cited in your opening statement, Senator. We need to move in the opposite direction back to a simpler, flatter tax structure. And I would suggest 3 ways to go to accomplish that. First, immediately begin a phase out of the so-called millionaire bracket of 8.82%. Commencing with the next budget, the rate should drop by 0.5 percentage point a year, culminating in a sunset at the end of tax year 2017. A tax increase that's supposedly temporary but is actually very significant, that theoretically is going to expire all at once at the end of some period of time, is something that is built to be extended indefinitely. You're creating a fiscal cliff for yourself by doing that. 2, permanently enact the temporary provision indexing to inflation all tax brackets, personal exemptions, and standard deductions. The federal government, as you know, did that over 30 years ago. It's high time we did it permanently. 3rd, aim to achieve a simpler, more efficient, and competitive tax structure by broadening the tax base to the extent possible, reducing allowable deductions while expanding personal exemptions, and pulling down the marginal rate to the extent that you can. I'd like to now turn to a second subject that I think has not gotten as much discussion as it deserves, and that's our estate tax. We're now one of only 19 states, a number that's been dwindling, that continue to impose either an inheritance tax or an estate tax or both. And this is leaving us a significant competitive disadvantage. However you may feel about the estate tax, sometimes referred to as the so-called death tax, regardless of how you feel about that as a tax policy in general or on the federal level, the fact of the matter is now that we are part of one of a dwindling number of states that still impose it, and that's a disadvantage. It's imposed at a rate of 16% on estates valued at over $1 million. It's particularly harmful to owners of family businesses and farms. Remember, that includes primary residences and even life insurance. So it's not that hard to reach $1 million. Senator DeFrancisco has proposed taking an important first step in the right direction by raising the taxable threshold from $1 million to the federal level of $5 million. And the revenue impact of that would be negligible, and so I think it's an obvious step, but I think we also need to go further. The goal should be nothing less than a phased-in elimination of the estate tax, which, of course, because it raises $1 billion a year, would have to be phased in. Keep in mind, however, that the revenue from this tax is offset to a degree as yet unknown by ongoing economic and revenue losses resulting from encouraging some high-net-worth households to move elsewhere, taking their incomes, their philanthropy, and other economic activity with them. With a maximum rate of 7.1%, our corporation franchise tax on a statewide level is lower than those of neighboring states. However, it should be noted that that 30-year-old Metropolitan Transit District surcharge in the New York City region actually boosts this tax to 8.3% throughout that region. And in New York City, with the corporate tax rate there, it's over a combined federal, state, and local rate of over 16%. As you know, many businesses have a choice of organizing in ways that subject them to one tax or the other. You've taken steps to allow small businesses to file under the personal rate. But I think that to achieve true neutrality, you want to align all your rates, personal and corporate, at the same level to avoid economic distortions, with the goal of reducing the statewide tax to an absolute minimum. When county and New York City rates are included, turning to another subject, we also have one of the nation's highest sales and use taxes. By broadening the taxable base for the sales and use tax to include, for example, personal and professional services now exempt from the tax, you could raise enough revenue to put a dent in the current rate, which typically is at least 8% in most parts of the state. In addition, if you assume enactment of the proposed federal Main Street legislation, which would clear the way for uniform taxation of online sales, if that happens, there's two things I would suggest that need to be done. First is to direct the tax department to report within the year on the amount of revenue, added revenue this tax is generating. Based on that finding, secondly, commit yourself to reducing the sales tax rate by a like amount. That is, if it raises $600 million in revenue, or about 5% of current tax collections, you could reduce the rate by 20 basis points on the state level and encourage local cuts as well. Now, again, these recommendations are just a start. I've just cut across the surface of some major tax themes, but in the time left, I'd be happy to engage in a discussion of what some of the implications of these things are and other ideas. Thank you.
Thank you. Any questions? This one, Senator Valesky.
EJ, thanks for your testimony. I'm familiar with certainly most of these proposals and thoughts that you've shared with us this morning. I'm less familiar with your last point in regard to enactment of the proposed federal Main Street legislation. Are you, when you say assuming enactment, how confident are you that the federal government is going to do that? I'm just not that familiar with
I'm not sure how confident to be at this stage. For a while it was moving, and now it seems unclear whether it is moving. Your next speaker might have more light to shed on that.
Okay.
But since it's definitely a possibility and a stronger possibility than it has been at any point in the internet era, it is something to be aware of. And I think that the state should commit itself now, especially given our very high rates, to not simply glomming onto the added revenue and doing nothing. It's an opportunity if you have a one-time bump up, but a permanent bump up in revenue resulting from this. It may not be quite as large as some people have implied, but whatever it is, I think it's an opportunity to begin whittling away at the rate, which is quite high.
Okay, thank you.
You're welcome.
Senator Kruger.
Good morning. How are you?
Good morning.
As we have discussed on any number of times, while we may have different political ideologies, we come full circle when it comes to tax policy very often, and I appreciate your analysis. And I find myself in great agreement with much of what you've proposed. I wanted to jump back to your discussion of two different ways to file taxes as a business in New York, and the I forgot the term you used. I don't think you have it written down, but the real differentiations we see in how much taxes are being paid by whom, and I share your agreement, the problems when two businesses may in fact be very parallel in everything except the taxes they pay. Could you give us a couple of examples?
At the risk of greatly oversimplifying, two businesses, and it could be a service business or a manufacturing business, not tiny, but call them smallish, okay, employing a couple of hundred people, gross revenues of a few $1 million a year. For one reason or another, one of those companies may be organized as a C corporation, fully incorporated. It is Service Corporation, Inc., and the other may be a subchapter S corporation organized as some sort of partnership with some multiple personal owners. And depending on, especially and also their location in the state, they could be subject to two different, one would be subject to Article 9A and the other could be subject to personal income tax. Now, we've taken strides to kind of reduce the differential, any differential in the way we tax them, but the ideal for tax reform is to simply treat them as alike as possible. We do offer credits. For instance, if they're a manufacturing business and you're eligible for an investment tax credit, I believe you can claim the tax credit against income both as partners in a sub S and or an Article 9A C Corp can use that credit to reduce its tax burden. So there are parallels there. But to the extent there are any distortions, it's just something to be aware of. Like when we talk about reducing one rate or the other rate, we need to be more aware up front of any differential we're opening or creating between the two different rates. So for instance, right now, if we ever went permanently to an income tax of close to 9%, we would have reopened a differential, and you never know, perhaps created an incentive for somebody to think harder about organizing as a C Corp. One of the benefits of thinking and talking about tax reform is to think harder about sort of general principles. And one general principle that you alluded to is that people engaged in the same sort of economic activity should be taxed to the greatest extent possible. It's difficult to be perfect, at the same rate. If you and I are doing the same thing and making the same income from that thing, tax policy should be aimed at taxing us at the same rate. And that was the point of that allusion. I think in the past, when we made great strides in reducing our income tax, we didn't take account of what impact that would have on how people would organize. And so to a certain degree, we've kind of caught up with it again. We're offering smaller businesses the ability to file at a personal income tax rate, for instance. But I'm just saying that there'll be a lot of talk today about ways to reduce the corporate income tax, for instance, and to restructure it. That in doing that, or in reducing the personal income tax, we should be conscious of that goal of horizontal equity, of treating all of the people involved in the same activity the same way.
I'll follow up on another statement you made where you shifted a bit to these local tax issues. There are proposals, I think from later testifiers, about actually having different tax rates depending on what county you're in the state, and reducing significantly sales tax, which is obviously a significant income source for our counties and our cities. Given the economic problems our cities and many of our counties find themselves in, I would even argue on the verge of crisis, how do you see dealing with the concerns about equity and balance in tax policy with the demands that we are seeing at the local level all over the state?
Well, if you're alluding, are you alluding to the proposals for local income tax, for special local income taxes, or variation?
I think a couple of the other testifiers had already put out statements to the press calling for reduced taxes in certain counties,
okay,
and also in reducing specifically sales taxes.
Well, I mean, I haven't seen all of those proposals in detail. I think I'm aware of some of them, but I think that to the extent they're aimed at promoting greater tax competitiveness in troubled localities, then obviously it would create some benefits. I mean, if we're able to, for instance, the idea behind reducing the rate at least a smidgen if, for instance, more revenue is generated by the so-called Main Street tax, or the revenue generated by broadening the base. If you could, for instance, theoretically generate a net $1 billion more in revenue by broadening the sales tax base to some things that are not now taxed, which would allow you to reduce the rate by a certain amount, say up to a 0.5 percentage point, you would be creating a similar benefit, although not completely evenly, for localities across the state, and giving them the opportunity to become more competitive by reducing their rates. And so it would actually ease the way for those types of proposals, if I understand those proposals correctly.
Thank you.
You're welcome.
Thank you for coming, and thank you for your testimony. It's very interesting to see. Just a broad question. Senator DeFrancisco mentioned earlier that some states have gone to a flat tax. Should New York?
I'm sorry, I didn't hear the whole question.
Some states, as was mentioned in Senator DeFrancisco's opening statement, have already gone to a flat tax. Should New York?
Well, I think a flatter tax structure, I'm in the school of thought that believes a flatter tax structure is a better tax structure. We had post-1997 gone to a flat-ish tax structure, or less steeply graduated than it used to be, but nonetheless with a progressive result. By the way, I'd like to point out here that in 1987, there was a very overwhelming bipartisan consensus in favor of a flat tax in New York. In fact, the Assembly Democrats proposed a pure flat tax, and the Republicans in the Senate proposed a modified one. So this is something that has been raised before in New York. When we collapsed our bracket structure down to many fewer brackets than there had been before, we were moving in that direction. I think that you can create a tax structure that is flat or almost flat in terms of its rates, while still having a progressive result in terms of the distribution of the tax burden through the use of larger standard deductions and personal exemptions. I think we did that in New York, and in fact, under our permanent code, as was in effect with one 3-year interruption before 2009, we already had a progressive distribution of the tax burden with a relatively flat structure, not necessarily purely flat, but pretty flat. And I do think it's a desirable thing to have as broad a base and as flat a rate as possible. I think that's the consensus of many, not all, people in the tax field. That steeper marginal rates are a disincentive to investment and to income earning in the jurisdiction that imposes them.
You mentioned expanding the state sales tax to cover personal and professional services. Would that mean a greater burden on the business community in the fact that as more companies are required to navigate the state sales tax system?
Well, it would redistribute the tax burden to more businesses, and that's why it needs to be considered, but also studied in more detail. There's a lot here that would require further study. Certainly, one of the problems with the sales tax in general that's frequently overlooked is that the sales tax is administered by the people who collect it, in effect, and it is always, to a certain extent, a burden. But a consumption tax is arguably, especially if it's broader, is in some ways less of a burden or creates less of a distortion than a heavier reliance on income taxes. And that's why they've always been part of the mix. So the question is, if we could lower the rate significantly or at least noticeably on other types of sales and business activities, would it be worth the added impact of having more businesses collect the tax on other things? I think it's a question that you need to examine. There's so many myriad aspects to this that it's hard to give a blanket answer. But there's no question about it. If you have more types of sales subject to a sales and use tax, you have more businesses involved in collecting the sales tax.
Some have said that a flat tax, you'd have to eliminate deductions that are very popular right now, charitable deductions, the property tax deductions, things like that. I gather from your testimony that you would favor retaining some deductions in the system if we go flatter.
It depends. This would require further. I have not done a detailed, thorough study of the alternatives, depending on also what your revenue target is and if you're willing to forego and how quickly you're willing to forego the revenue you have raised through your temporary tax increase. But certainly there's an argument to be made from curtailing a lot of deductions, and how that affects individuals depends on what you do with other aspects of the tax code. If you do enough of a reduction in the rate, a lot of people could realize no net increase, even a small net savings from a tax code that eliminated many of the deductions they might be eligible to take. In fact, one of the most revolutionary changes of the 1995 tax cut, following up on the earlier tax cut of 1987 and fulfilling it and going a little beyond it, was the expansion of the standard deduction, which has resulted in a much larger number of New Yorkers finding it to their advantage to take the standard deduction and not even having to use those itemized deductions. At the moment, you're not allowing your highest income taxpayers to claim most of their itemized deductions in some categories in any event. So I think that you need to think about how many items, those are some of the items you need to think about. In other words, how many people actually are itemizing now? What deductions are they claiming? And how would they do if you completely restructured the tax code? For instance, if you could figure a way to eliminate or phase out the so-called benefit recapture. That is the aspect of the tax code that makes the tax rate, the top rate, a flat tax in several categories. In fact, as I should have responded to you earlier, we have a flat tax for some people. Everybody who earns over $150,000 pays a flat tax, and people who earn over $1 million, starting for individuals, pay another higher flat tax. So you have kind of the worst of all worlds. You have a graduated flat tax rate system, starting for certain people in certain income levels. You need to back away from that approach in general, I think. And if you had a true flat tax, all the other things you could mix and match into that could result in no net tax increase for the vast majority of taxpayers. They wouldn't be quote unquote losing something even if a deduction was taken away.
Thank you very much.
I just have a few. First of all, the thing I hear most and have heard most since we indicated that we're going to have these hearings is, we've been cutting, we've been we passed a tax cap for property taxes. We can't afford to do any more tax cuts. We just can't afford to do it. What would your response be to that?
Well, first of all, the problem, one reason some people might feel you can't quote unquote afford to do more tax cuts is that actually, in the sense of what that phrase tax expenditures, you've already spent a lot of money on targeted tax cuts. You're committing over $400 million a year in outright subsidies to the motion picture and TV industry, including what you're paying, and let me use that word advisedly, paying NBC to build a studio for The Tonight Show. I mean, that's one reason why you don't have the money to quote-unquote afford broad-based tax relief. The problem now is that you've got so many targeted tax cuts soaking up so much capacity in terms of resources that you may feel that on the margins you can't quote-unquote afford it, but I think you could afford more if you undid a lot of the targeted tax credits you've enacted and also, in addition to exercising spending restraint necessary to do and devote yourself to broad-based tax cuts. I think targeted tax cuts become an excuse and a distraction from doing broad-based tax relief.
And I remember that same refrain during the Pataki administration when the last major tax cut in 1995 or 7 that you were talking about, I can't remember which year. But somehow the book still balanced after the major cut in rates. You just spend less, I guess, is part of the answer. The second part of the answer is what you just mentioned. You can't have you can't have everything. So we've got to think of a methodology as to how we can approach this subject to get a true broad-based tax cut. And I want your thoughts on this methodology. Right now, according to the Tax Foundation, we're like 50th, and most of the problem is our tax structure, or a good part of it. Let's suppose that we wanted to aim to be midway. Obviously, we're not going to be competing with Texas next year with no income taxes. But say we wanted to go midway. Would a methodology that makes sense figure out what the number is you need, look at all the different categories, including deductions, like Senator Marcelino talked about, look at whether this Main Street tax comes in as a potential source to fill that number, and in addition, credits, like you just referred to, that you can't, and presumably if you have a fairer tax structure, everybody benefits rather than the favored few. So is the methodology of finding the number, it makes sense to find the number that you want to reach and figure out how you arrive at that number, or do you have a better methodology?
Well, in general, if you wanted to even move halfway toward the national norm for combined state and local taxes, you'd have to reduce taxes by billions of dollars. I don't know the exact figure right now. I think at one point I calculated it was $3 or $4 billion a few years ago. Some big strides were made in that direction in the mid-1990s, and then we retreated partway from some of those strides. I think that it's a combination of things. I do think that there needs to be, using the old cliche that the journey begins with a single step, or at least a few steps, there needs to be a commitment to broad-based tax relief and to doing it every year, to setting aside a certain amount of money in your financial plan every year for broad-based tax relief and only for broad-based tax relief, and to start doing it. And again, for example, when you structure a temporary higher tax rate so that it stays fully in effect up to midnight on December 31st of a given year, there's almost a self-fulfilling prophecy built into that. You're going to find it very difficult to yank away a $2 billion tax cut all at once you've spent up to that amount. And that there is a weaning process that needs to occur here, weaning yourself off that revenue and rededicating that revenue in a multi-year sense to tax relief. So I think the goal of looking at the financial plan and through a combination of reclaiming revenue dedicated to targeted tax credits, as you mentioned, the reclamation project, and also of suppressing spending to the extent necessary to dedicate a few $100 million a year. I suggested at one point at least $500 million a year, 250 to 500 just to start with, to phasing out of, or a move toward broad-based tax cuts would be a start. Just phasing out the higher income tax rate basically would require at least $500 million a year to accomplish. And I think you need to do that. You need to start moving in that direction and continue moving in that direction. And to complete, when you were talking about the 95 tax cut, I was involved in that. And that was literally one of those things about which they said it couldn't be done. Couldn't be done. It was preposterous. How can you propose a tax cut like that? Well, it was done. In fact, it was, quote unquote, paid for by spending restraint at that time, because while the economy ended up booming nationally and the state level, it was by no means clear that that was going to occur. In fact, we weren't out of the woods well into the second year when there were calls to repeal the tax cut. So that, I think, shows the way. That was a $4.5 billion tax cut. And I think it shows how these things are possible if once you've built it into the financial plan, it's part of what you have to do and what you have to deal with.
Thank you very much. A follow-up question by Senator Kruger.
Thank you. You were talking about the history in the 90s with the changes in tax policy, and you were also highlighting the tax expenditures that we distribute in the state. And so I want to just say on the record, it's $7 billion a year in business tax expenditures and deductions. Did we have anywhere near that level in the 90s?
I don't know what the level was exactly in the 90s. We've certainly done a lot since then. I can think offhand of a $500 million that we did. It's a lot. Some of that is, a lot of that are tax credits that were enacted before the 90s, though. However, also investment tax credits, for instance, could date back to the late 70s, early 80s.
And they've just grown at enormous rates.
Right. I mean, but the point is, if you simply reclaim, however they're valued, $7 billion, $5 billion, $4 billion, however you attach a value to the so-called tax expenditures, if you simply take that money and plow it back into the budget and spend it and do nothing with broad-based rates, you're not accomplishing anything other than making us even less competitive. And if you were to, for instance, given all of the business taxes we raise, if you took $7 billion and on a revenue neutral basis said we're going to cut all state business taxes by $7 billion, you would have a significant tax cut, obviously, on the rate side. And at least thinking in that direction and then beginning to think about the implications of some of the things involved in doing away with all tax credits and exceptions is at least a conversation that you ought to be having. And I think the thing that needs to stop is that we've come down a road now where every discussion of tax policy and of quote-unquote tax cuts focuses solely on targeted tax cuts. How can we give a break to this group of people that we want to give a break to, or this group of businesses? We've ceased having any discussion of broad-based tax policy in Albany. There's a lot of reasons for that. There's no need to finger point, but I think nobody will deny that that's the case. And it would be good to take stock and stand back and start going in the opposite direction.
And what I was trying to get, the answer, and you gave it to me, was that yes, we could do an enormous amount in impacting broad-based tax policy, equity, and also decrease many burdens on businesses if we dealt with the $7 billion. I hear you, not simply taking it out of the tax code and spending it, right, but taking it out of the tax code as is and moving forward with a broader base, equitable, even tax model. We could turn around tax policy in the state.
Well, for example, there is talk now, and one interesting idea that's been talked about is taking steps. Now we're in the middle of phasing down and reducing the rate on manufacturers. You can argue both sides of that in terms of tax policy, but there's a strong case could be made for it on some grounds. One thing to point out is there's a lot of tax credits and tax exceptions available to manufacturers. The beauty of eliminating a corporate tax on manufacturers is that you also eliminate all the tax credits and exceptions, because who needs to reduce their tax bill with an ITC if they're not paying taxes on their net income to begin with? So that is something worth considering.
Thank you. Thank you.
Thank you very much. We really appreciate it. The next speaker is Joe Henchman, Vice President of Legal and State Projects for the Tax Foundation. Thank you for appearing.
Good morning. Thank you, Senators. Thank you for the opportunity to speak to you today. I believe you've been provided with my full statement, which goes through 20 states on what they've done this year. I'm not going to do that here for you, but certainly if you have questions about any of them,